On December 3rd, 2020, I released a blog that listed every single one of my crypto holdings. And I'm constantly updating it. I'll link that down below. You can see it whenever you like. But on that blog, I also made a list of cryptos I was looking to invest in. Now, the punchline is I never did. I wanted to, but I'd never quite pulled the trigger. And as a result, as I sit here right now on Friday, April 23rd, 2021, these are the gains I missed out on. So tell me again why FOMO is a bad thing? Fear of missing out, also known as FOMO, is in the psychology section of the No Nonsense Forex playlist, though we've yet to go over it. What took so long? Well, you can't really paint everything with the same brush. There's trading and there's investing. And as you all know, we are now in the investing and buy and hold portion of the channel here in 2021. And this is something that I think just needs to be addressed now. Quick disclaimer, don't listen to anything I say. Do your own work. I'm not liable for any of it. Wins or losses, you know how this works. But in this video, we're going to talk about FOMO and trading. We're probably going to spend about 20 seconds on it because we've really already gone over it. And you guys, by now, even if you're brand new to this channel, probably know the answer to whether FOMO is a good idea in your everyday trading. But FOMO does exist in the buy and hold game in its many forms. And we're going to go over those forms and explain which ones are positive and which ones are negative, because they're not all positive and they're not all negative. We need to understand the distinction and be able to draw that line. We're going to talk about something called FIMO, which is something I just made up, but we'll talk about that when we get there. And then we are about solutions here at No Nonsense Forex, not just problems. So we will talk about how we can overcome all of these things. So FOMO in trading. You guys know, most of you know, I wrote a book on trading psychology, and apparently it's really good. Look at that. I will link below also to the video where I talk about the book. It's only a 7-minute video and just kind of tells you what it's going to be about, what you can expect, how much it is, and then I put the link down below in the description, and you can just go from there. Or you can just look up this title on Amazon and go the quick way if you're interested in what I have to say. But that book was on trading psychology. And I wanted to keep everything very compartmentalized into trading itself, not so much buy and hold investing. So I didn't talk much about investing, which means I didn't really talk about FOMO because it's pretty obvious that the F in FOMO stands for fear. Fear is an emotion. Emotions have no place in your trading. End of story. But they do pop up in trading, and this is all I'm really going to say about it. Because you might see some carryover into investing if you use technical analysis to decide your entry points or even your exit points, really, when it comes to investing as well. But the biggest times FOMO pops up in trading are when, let's say, you're following the No Nonsense Forex system and you haven't been trading for a while because the market's dead like it is now, and you finally get an opportunity, but not all of the pieces of the algorithm tell you to go. Almost all of them do, but there's that one that's almost there and it's not quite there, and you're afraid you're going to miss out on the trade if you don't go now and you just go anyway. These are things we generally want to avoid. There might be a big fundamental event. Because things have been so slow in Forex, there's not a whole lot of fundamental Forex news events that really propel the market in a meaningful way like there were in the past. I think we can all agree on that. So when one does come up and we feel like it's significant, we often want to jump on that train and we will ignore everything else, which again is deviating from your system, which again, my hardcore traders know not to do. But then when you're in the trade and maybe you haven't been having a really rough go at it, you've been taking some drawdown, you finally get a really nice trade and it's running really fast and it's giving you a lot of profit right away. It's about to approach that first take profit level, and you really don't want to take profit right now because you love this trade. The trade is on fire and you don't want to cut any of your profits short. So you deviate from your system. Really, what it comes down to, you guys know the big three ironclad rules when it comes to trading psychology and pretty much just trading overall. Step 1, trade your system. 2, stay the F out of the way. Step 3, repeat. End of story. There's really not much else to talk about here. But moving on to buy and hold, which is what 2021 is all about here on the No Nonsense Forex channel. FOMO takes a different face, and we need to dissect this a little further because I can guarantee all of you have experienced this at some point in time. And because of that, I can pretty much guarantee it had an effect on your investing, and probably not in the best way. Some of these might hit a little close to home, but they're supposed to. We need to identify them first before we solve them. Now, for some reason, I'll bet you there are some hardcore no-nonsense Forex traders out there right now, meticulously follow a very disciplined set of rules and never deviate from them. But then when it comes to their actual buy and hold investing, don't have a plan at all. And they end up like most retail traders who, just like Forex traders, don't do very well overall. Very few people actually retire off of their stock holdings. It's weird, but like the people that actually do were already rich in the first place, and they just gave their money away to a financial manager who just put them in some very low upside investments and just didn't lose their money, and they're happy with that. We want more out of life. We want more out of our trades. We want more out of our investments. Most of us sitting here right now aren't already stupid rich. So we need to find a way to get there. But we need to do so in an intelligent way. And to do that, we need to be better than the majority of retail traders because they're called dumb money for a reason. All right, we don't get to be smart money in the trading game and all of a sudden become dumb money in the investment game too. We need to be able to burn the candle at both ends the right way. But it's really hard to do, especially right now as I make this video in the spring of 2021. Because FOMO across the board, across the globe, is at an all-time high. Now, why is this? For one, markets are just way too good right now. We have been seeing upside that I never thought we'd ever see in my life. We've all been through the 2010s. That was a crazy good sustained bull run. We thought it couldn't get better than this. And then we had a drop, and then it actually got way, way better in so many different markets. But this is not how markets are supposed to be. This is an anomaly. And there's so many people out there that either think it's just going to be this way now, or they're young and they have no frame of reference and they think this is just how markets are. Neither one of those things are true, but we're seeing it in crypto, in a lot of stocks, in real estate right now, with the price of commodities. We're seeing it in base metals. We're seeing it in soft commodities. We're seeing it in so many different places. Who's to tell us otherwise that things are ever going to go back to normal? It's crazy right now. And you know what? Maybe I'm wrong. Maybe there is a chance, as small as it might be, that this is just going to be the way of things from this point on. I'm not going to say it's impossible, but I will say it is highly, highly improbable. And because of that, things will go back to normal someday. And once they do, a lot of people out there are going to be completely screwed psychologically. Now, how is that possible? Well, for one, they have expectations. A lot of investors have now just become accustomed to and have grown to expect these off-the-chart gains because that's the environment we're in right now. And if you're young and you just got started a year ago or even a few years ago, all this crazy upside is all you know. It's your entire frame of reference. Not only are your expectations to have all these crazy multiplier gains all the time, you have also seen a really big dip back in March 2020, and you've seen a series of dips, but all you really had to do throughout all those dips was just either buy and hold and sit tight, or buy more when these dips come, and then everything was going to be okay. Let me tell you, I'm not the most experienced investor out there, but I do have about 5 to 8 years under my belt. I study history, and the world is not really like that. Once we get out of this insane bull market, like I said, I could be wrong. It could be the way of things from now on, but I doubt it. I think things are going to return to normal. I think things are going to get really, really awful before they return to normal, but at some point, we're going to get back to this world to where something like a 12 to 20% gain in a stock year over year is a great thing. A 15% gain in your overall portfolio is a great thing. 15%, I mean, that's what like Madoff was getting, and that's why he got so many clients. If you're a firm in Manhattan and you are beating the S&P, by 3 or 4 percentage points every year, you will have a line of rich people out your door begging to get in and invest with you. That's how significant these things are in the real world. But the home trader doesn't understand that, especially now, because the extremes are so crazy. Now, how are those people going to react once we get back here? They're going to be screwed. Young people are going to be totally screwed. Imagine that young athlete that the first job they get is when they turn pro and they get millions of dollars. Now, let's say they play for a few years and then they leave. They get hurt, their career got cut short, whatever the case is, and now they have to go back into the real world and work some job that makes, $30,000, $40,000 a year. Now, for a lot of people, especially young people, a $30,000, $40,000 a year job would be a joy. It'd be super exciting. It would be a huge get for them. But to that person who was making millions, now to make a small sliver of that and have to work a lot more and have to work hard and be motivated every day, good luck. That's not going to happen. Because their expectations started out way too high from the beginning. That is my biggest fear for young investors right now. We are seeing people right now come into the investment game probably anywhere from 5 to 10 years earlier than the average age would normally be. And I think that's awesome. How is that not a good thing? The younger, the better, because that's more time you have to get experience and to learn things and really make finance a part of your life, which it needs to be part of everybody's life. Financial knowledge is not something you can just not have. We've talked about this before. But the downside is when you're coming in now and your only frame of reference is these crazy multiplier gains, and anytime there's a dip, it just gets good again all the time, well, your future is completely screwed because this is all you know, and it's not going to be like that all the time. So what I'm really worried about and what I really think is going to happen is, me, I think it's going to get really bad before normalcy resides again, but normalcy will reside, and when it does, people are not going to want to shoot for these, smaller incremental gains. Instead, they're going to look for what they know, for what they remember, and that's those crazy 4 to 5x, 20x gains. And in a normal environment, anything out there that has or promises an upside of 4, 5, 20 times gains is probably going to be extremely speculative and very low probability. It's not like now where the crypto market has a very high probability of taking off if you just get in the right time. Almost doesn't matter where you put your money. It's going to be good. It's not going to be like that. And things with stupid upside are typically going to be stupid investments. And a lot of these younger traders are going to be putting their money down there because they don't want this. I deleted the next bullet point. Moving on. So you guys have all heard these terms. You've been in the investment and trading game at all. FOMOing in or YOLOing in, or the big one now is aping in, if I spelled that right. Now, are these things positive or negative? So if you don't know what they are, pretty much what they mean is I don't have a lot of real justification for jumping into these trades, but I'm afraid I'm going to miss out. And if it's going to be crazy gains, I want to be a part of it. So I'm just blindly going to enter the investment right now. Positive or negative? What do you think? Well, you probably know the answer is both if you've been paying attention so far, but let's focus on the negative because I think that's the more obvious one. First of all, this is an awful habit. If this is going to be the way you enter trades from now on, I am very, very bearish on your future, and I'll put a lot of money down on the opposite side. Please have a better reason for entering an investment than just blindly jumping into it, even if it's money you can afford to lose, because this is a horrible habit to obtain, and you are probably going to have it in the future when there is more on the line. Again, especially if you're young, because what's going to happen is you're going to be right some of these times, and you're not going to forget the feeling you had when you, this guy who really doesn't know much about the market at all, and you still think you're super smart, jumped in to a trade and it took off, and you have all your little Reddit buddies patting you on the back and you're making all this money and you feel amazing. You will never forget that feeling. And Just like that first dose of heroin, you're going to be chasing that feeling the rest of your life if you don't wise up. And like I said before, your chances of making any real money in investments, especially long term, are gone. Have fun with it now, kiddo, but work on developing a much more intelligent approach for the future. I don't blame you for getting it while the getting's good, but just don't think this is the norm, and do not carry these habits over into the future. Start developing good habits now, not later when it's too late and you lose a bunch of money learning how. Develop those habits now, and the rest of this video and future videos are going to show you how to do that. But the big question remains. VP, I pretty much knew FOMO was a negative thing. Even though, I'm probably guilty of doing it myself. I know it's not always the right way to go. But fear is an emotion. Emotions have no place in what we do. I know all that. I know it's negative. How on earth is FOMO a positive thing? Well, look, it can be a positive thing, but that's conditional. That's why I have this asterisk here, and we will talk about it. But one of the ways I think it can be super positive is because there's a lot of markets and stocks and maybe cryptos out there that you have been looking at. But since there is so much upside in the market, that means things are also very volatile, and that worries you. And that should worry you. That's a good response your brain is having right now. That's a good caution. I naturally have that same caution. And it was that very caution that prevented me from getting into all of those cryptocurrencies I showed you on the very first slide of this video. And as a result, I missed out on all those gains. So if you want to FOMO into things now would be the time. Might I be saying this at the very top of the market? Maybe. I did a great job of accidentally calling the bottom of the market back in 2020 through no intention of my own. So it could happen. But if you get in now, you're still going to be earlier than most people, I think. This is not a recommendation, but especially in crypto. If this really is the way we're going to be transacting money, and if this really is going to be Web 3.0, and I don't see tokenization really going anywhere but up, down the road, you're still going to be relatively early. So if you've been thinking about it and you just need a little bit of a push, allow that FOMO to get you there. Because if you're not going to take advantage of these crazy anomalous times that we might not see again for generations, then you're going to miss out on the gains. And those gains are good. Those gains are going to help cushion future losses. Those gains are going to give you a nice account to play with down the road. There's a lot of upsides to this. If anything, it's going to make you learn more about that thing you're invested in, and that's just going to further your education, and that is going to give you more experience, which I said before. Experience is something you just simply cannot put a price on. If you lose a ton of money, but you gained a ton of experience, long term, that's probably going to be a net positive. There are so many no-nonsense Forex traders right now who follow everything to the absolute letter and have done everything right and are crushing it in their back testing and their forward testing and even maybe their real money testing, but they just don't have any experience yet. And a lot of those results are going to drop once they get out there in the real world, just because they don't have the experience yet. And that's when the next test comes. That's when you have to really say, yes, I'm playing for the long game. I'm going to grind this out. I'm not going to deviate from what I learned, and I'm going to get that experience, and I'm going to get better and better and better. The same thing applies to investing. I didn't get into crypto, for example, super early. I got in relatively early, and I did some really smart things. I did some really dumb things, and I learned a lot along the way, and I gained experience. And because I've gained experience, now I have also gained confidence. And again, you can't put a price on it, and the sooner you get started, the better, even if it costs you a little bit up front. If you find something you like and you've done the research and you're bullish on it, even if you don't know much about it, just get in there. You don't have to put a ton of money down on it. Just put some money down on it and get into that ecosystem and learn by doing. And if that fear of missing out is the one thing that takes you over that line and gets you there, then all the better. I'm grateful for FOMO in that regard. I would have never entered the market in a field that I knew very little about had I not, one, taken the time to learn a little bit about it, and then two, be completely afraid to not participate into what I see could very well be the future of money and the future of the internet. Just couldn't pass it up. I was afraid to miss out. And I'm glad I had that FOMO. But from FOMO, we move on to FIMO. And this is almost the opposite of FOMO, but I think this is something that affects a lot of people too. So I really think we need to talk about it. Now, I'm not some great visionary that invented this term. I looked it up. I didn't see anybody else calling it this. I'm sure it goes by another name. Feel free to tell me in the comments. But FIMO, to me, the way I define it, is the fear you missed out. Let's say by the time you get interested in something and you look at it on a chart, that chart already looks like it went parabolic. Or even worse, let's say you were already keen to something, whether it's a stock or cryptocurrency or anything, and you were looking at it right about at the $5 mark. And instead of FOMOing in, instead of pulling the trigger, you sat back and you hemmed and hawed and you said, all right, well, maybe I'll get into it a little bit later. Maybe if the price drops a little bit. And now all of a sudden it's at $10. And now you don't want it because you wanted it at $5. Now you're getting half the amount for twice the price, and you don't want to do that. Now that is another part of FIMO. So it already ran too far. I missed it. That is what you were saying in your head. But did you really miss it? That's my question to you. Whose criteria are we talking about? Yours? Are you somebody who gets paid to put valuations on stocks or cryptocurrencies? You're probably not. You probably have no idea what you're doing, yet you're pretending like you do, and that is justifying your own fear of entering something you don't feel like you know enough about. It's not that something just ran from 5 to 10 and you missed out on the 5. It's more your lack of education or your lack of conviction or your lack of experience dealing with this particular asset. Let's call it what it actually is. Now, don't get me wrong. It all depends on the market. If a stock moves from $5 to $10, most cases that is way too far. Now, if a cryptocurrency does that, that can be a completely different story. You have to be able to adjust. And we will talk about that in a moment. But I want to better illustrate FIMO to you by playing kind of like a little real-time game. Now, you might already know the answer. You might already know what to do. But let's go to a chart and kind of walk through the whole FIMO process. And I guarantee so many of you guys have already had it. I've had it before. Let's see how our mind plays tricks on us. Okay, so we're here on a daily chart. Now, I kind of moved out of the way so you couldn't see what the asset is. And I moved down so you couldn't see it up there. We can't see the price. We can't see the time. So we don't have anything to go on or to give us any clues to what this asset actually is. So let's see, 1, if you know what's going to happen. 2, if you can guess the asset. Do not put it down in the comments. You don't get points for it, so just play along. Anyway, you have seen it go up, and you have seen it crash, and now it's starting to gain momentum again. And you're like me. You're like, I am interested in something when it crashes like that and then finally starts to gain traction. That is my sweet spot. And right about here is the date where I say, okay, I want to enter this. I want to be a part of this. But for some reason I don't. And then it starts to go up, like really up. Starts to level off a bit. Now, I wanted to get in here, but I didn't, and it ran without me. So what are some of the things we tell ourselves at this point? Well, we might just lose interest altogether. We might be so in love with the price we had down here, we're like, screw it. If I can't get it here, then I don't want it, because I'm a world-class asset evaluator. At least I think I am in my own head. And, if I can't get it there, I just don't want it. We might say something like that. What is something else we might say? Well, I still want it, but I'm going to wait for a pullback. Well, it's pulled back. Did you define how far that pullback was going to be? You probably should have done that, because now instead of following a plan, you're just playing it by ear and you're winging it and you're following your own emotions. And you probably didn't think this was really going to be a pullback, so you didn't participate. You're like, I'm going to wait for a real pullback. And that pullback just never came. It actually did, but now it's way the hell up here. At a much, much higher price. And maybe you should have taken that, because it just kept going. Let's pull all the way over. Still going. Still going. This here, can I move it? No. This is Ethereum. Just to give you an example, how when you have these things that you might feel are the future of whatever, and you're really bullish on it, don't sit there and play the pricing game. Just go in. There's that old saying, a fool knows the price of everything and the value of nothing. If you feel like something is valuable and you want in, don't sweat the price. Just go in. Now, is it a good idea to enter when something just went parabolic? No, but this didn't go parabolic. This had already kind of crashed and is on its way back up. It's a perfect time to enter. So just do it. There we go, Ethereum. This is how we miss out on these huge gains. And we talked about in No Nonsense Forex trading how losing is just part of the game. It's something, over time, especially when you get that experience, that you just grow accustomed to, because we lose trades all the time. But missing out on a really big trade for no good reason, those hurt worse because those are completely inexcusable. And in a lot of cases, the same thing happens in investing too. So let's talk solutions. It shouldn't be really a kill. Kind of how to master your FOMO and your FIMO, because in both cases, the F stands for fear. And if we can just take the fear part out of the equation, the better off we're going to be. So first off, a lot of fear comes in the risk. But if you're only investing money you can afford to lose, then it's not so risky. But so many people aren't doing that because they see others getting super rich off of all of this upside, and they want to be a part of it too. So whether they have money they can afford to lose or they don't, they're still FOMOing in. Bad idea. Why? Because you're way too close to the money you spent on that investment. And now you're emotionally invested, and those emotions are going to get in your way every step of the way. Now, if it's money you can afford to lose, and you don't really deeply care about that money, then you can sit back and you can chill and you can make the right decisions. But when you got some money on the line that, it's got to go up or else, that's when all the problems come. That's when the investment itself might do really well, but you don't do that well because you exited at the wrong time or you didn't take any profit along the way. When you're that much, that's what emotions do. They screw up everything. And that's what's going to happen to a lot of these younger traders, especially people in a very high upside market, like some of these stocks, like cryptocurrencies, when everything starts to come down. When the tide comes back in, there's going to be a lot of people standing there naked. That is how important money management and psychology is, no matter what you are doing. And we are going to see it manifest itself at some point. And there's going to be a lot of broken hearts out there because they allowed their heart to be in it. Now, when it comes to FIMO in particular, one of the best things you can do is realize that you don't know how to evaluate assets. I don't either. But as always, the difference between you and I is I actually realize it. So many people think that, something's good at 5, but it's not good at 7. It's ridiculous. You know how to avoid all that is you take a very long-term view. So you don't care what happens to the price in the short term. You're bullish on the future of it. Therefore, you can just go ahead and get in now. If it's at 7 and it drops to 5, so what? You're not in it for the short term. You're in it for the long term. That's pretty much my overall holistic approach. My one biggest piece of advice is if you've actually done the research and you're willing to play the long game, just get it now. FOMO into that sucker. You're doing it for the right reasons. You're investing money you can totally afford to lose. You're not sitting there and trying to needle pick the price, but you're still very bullish on it for the long term. Get in. Just do it. It's okay. Now, depending on it, this is the hard thing about an investment psychology video. One, it's not totally in my wheelhouse, but two, trading psychology, at least to me, is so easy because it's so regimented. You do this, you don't do that. Real simple. A lot of times in investing, you can go so many different ways. So allow me to give you some tips that I've had success with in the past. And you can either use them or maybe don't use them. But starting with the tranche system. If you have seen the movie Big Short or you speak French, you know what tranches are. Let me just define it for you. So even that's kind of wordy. Really, it's just decide, okay, I have $100 to invest in something. I'm going to divide it into 2 tranches of 50. And so what you do first is you FOMO into something, but you only put half of it in. So if it goes up, great. But if it goes down, a lot of that fear is erased because that fear becomes a good thing, because if the price goes down, awesome. Now you can get into that asset that you're super bullish on in the long term for a cheaper price. Just make sure you write down what that price is and you actually follow those directions. Do not do anything on the fly. Do not do anything by feel. That's still universally known. Now, you can divide your tranches into whatever you want. I like just doing it by 2. I think doing it by any more than 2 just complicates things. Oftentimes, I'll go half in, and if the price drops at a certain point, put the other half in and just let it ride. Super easy, and it makes the news of the price going up or going down, both, very good things. Win-win. Also, if we go back to the cryptos that I passed on, I liked them all. I think Matic really was going to be the next one in, but I did kind of go back and forth on which one, and it cost me time. I think what I should have done, and I gave this advice to somebody in Discord, is let's say you have, just because there's 6 here, you have $60 to invest, and you can't decide which one to go in on. Just put 10 in each one. That way you have exposure to all 6. There's going to be no regret if you pass up on one, and that's the one that goes crazy. And you get some nice diversification. You don't put all that 60 into one and then just hope for the best. So that's a really good way to go. I understand that if you're watching this in April of 2021, there's still Ethereum gas fees to deal with sometimes. But just eyeballing this, I think I can get almost all of these on Binance. Yeah, either way, the gas fees are not really going to be much of a problem in the future. They're getting better right now. We got the Binance Smart Chain, which is getting really popular. A lot of ways to avoid that. So if you have 60, just put 10 here, 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 and now you got a nice little basket of 6 cryptocurrencies, and there you go. It's a really good way to fight indecision. And you might think that's obvious, but this was honestly the indecision that was holding me up. And by the time I figured out what the hell to do, these gains were already starting to happen. And my own FIMO started to kick in. And I said, screw it, I'm just going to go put that money into cash. And I did, which is fine. I'm not mad at playing defense, but I missed out on all this as a result. I should have just went for it. Now, staying with crypto, there are some other things I can tell you that I learned the hard way, and maybe you can learn from my mistakes. First off, to a lot of you who have been in the investment game for a while, you have to understand this when it comes to overall percentages. We love percentages because they carry over into pretty much everything. Not here. If you're coming from legacy finance and you're a stock trader, you can't use the same percentages you used in, stocks for the last 15 years over here in crypto. You're going to make a huge mistake. Because if you're in the legacy stock system and you see a stock move up 50%, you're not touching that stock. That's a ridiculous one-day gain, and you don't want any part of that. That's a pump, or that's super anomalous and likely never to happen again. But in crypto, a 50% gain is not unusual at all. As early as we are into this whole cycle, this is still really, really brand new. You got to understand, if this is just like investing in the next Microsoft and everything like that back in the 90s, it's so different now. Because back in the 90s, we had no way to talk to each other. It was pretty much just, the rich people who were connected and the people who were able to pay for information, which normally came in the mail, by the way, that even knew where to go and what to do. And even for those people, it was still super speculative because even back then in the 90s, a lot of people didn't think the internet was even going to be around that long. Now, not only do we have this brand new phenomenon in front of us, it could be the way we do things for the next 20, 25 years, and we could all be super early to the game. I could be totally wrong about that, but I might be right. And if I'm right, and we're all able to talk to each other and get in super early, then we have to understand a 50% gain, a 200% gain in a day is not unusual, and therefore should not always necessarily deter you from putting your money into that cryptocurrency. I personally like to see some money come into these things because I know so little about them. So many of them are small little currencies and projects that aren't going anywhere. I actually want to see some money and some liquidity get into that market. And then I want to see more money go into that particular project. That tells me that there's a chance that this thing could actually be legit. And then I'll come in later. And I'm okay with that. But I certainly did pass on a lot of really profitable opportunities in the crypto space because it had moved up like 15 or 20% in a day, and my legacy finance brain told me to avoid. That's not how it works. Not here. So the best advice I can really give you is if you like it, enter, and just keep your eyes on the long term. Be right, sit tight. There's the old quote by Rick Rule, I think, says, the market can stay irrational longer than you can stay solvent. To all of my legacy finance people who are looking to get into the crypto space, this will redefine the term irrational. So you just got to be along for the ride. Don't worry about what it does. If you're bullish on something, be bullish for the long term and just ride it out. Did I miss out on some really great projects? Yes, I did. Have I made some really bad picks? Yes, I'm in one right now. But that's okay because my portfolio in crypto is up really, really well because I eventually took this approach right here. So learn from my mistakes. Now, you've probably heard me say it already, but the best way to remove emotions from the equation, as we know, is to have a plan, have a system, and then you follow it. And if you manage to do that, you would be amazed at just how often emotions stay out of the way. They're still going to be there, but they won't negatively impact what you're trying to do. Now, here on the No Nonsense Forex channel, we do just about everything in a very contrarian way. Now, how do you take a contrarian approach here? Well, you do the things that most people don't do. Most people don't have a plan. Most people don't enter a trade and then write out how they're going to manage it. Almost nobody does that. It's the right thing to do. It's absolutely the right thing to do. It's what institutions do. It's what family offices do. Do you think those places just enter a trade and then just wing it? No. They have a mapped out path to how that trade is going to play out, whether price goes up or whether price goes down. But your average retail trader doesn't do that at all. Do you want to be smart and disciplined, or do you want to be like them? Take a pick. Then do more research than the amateurs do. You know what I'll bet most people do? And I don't have any evidence to back up any of this because it just doesn't exist, but I would be willing to bet that most people who ape into cryptocurrencies either saw somebody talk about it on Reddit or they watched one person's YouTube video and they said, yes, that is where I want to put my money. Now, anybody that's been doing this for some time, does that sound like a smart approach? It's a terrible approach. It's a very young, inexperienced person's approach. Don't do that. Do more. Do more research. Get other opinions. I know, especially in crypto, it's so brand new. Nobody really completely knows what they're talking about. But unlike the 90s and unlike all the times before, we have enough information right in front of us to make a much more educated choice than we ever could before. So utilize that and use it. Why on earth wouldn't you? It's your money. Next, after the trade is entered, do not immerse yourself in the day-to-day of the markets. It will drive you crazy, especially in crypto, actually especially in stocks right now. There's so much crazy stuff going on in the world of stocks. I don't pay attention to any news that affects anything I am in right now. I know exactly what I'm going to do with it when it gets to a certain level, and that's it. If I ever do watch any kind of news on, say like a gold mining stock that I have, it's just because I'm bored and I want to watch something, and that interests me because it's a stock that I own. Apart from that, I ignore all that stuff because I'm good. I've mapped it out. I don't want to give emotions any chance to enter the fold. And so I just be right, sit tight, sit back and relax. This is no different than we do our trades, just on a larger, more long-term scale. Now, some of you might be sitting there saying, you're talking about this plan. Could you go into a little more detail? Like, I would love to put one together. I just don't know how to structure it right. I am going to go over that in a future video. I don't want to kind of combine two videos now. I think this has kind of gone long enough. And I think it's going to be next month's video. It might not. You guys know this year, if I find a reason to push a video up, I will if it's appropriate. but I'm going to say 90% chance we're going to go over that in next month's video. So sit tight. Let's wrap this one up. In conclusion, FOMO is usually a bad thing because it's the fear end of it. You're not being disciplined, and this is usually a trait you will find in people who are not very good at trading or investing, so you should generally avoid it. But it can be good if it gets you to actually act on something that you're afraid to act on because of unfamiliarity or because you think it's too risky, whatever the case is. But if you have a plan of action and you do your due diligence, a lot of these fears go away. So if you're doing it right, FOMO sometimes can be a very good thing. And that plan I'm talking about, you will see in a future video. I will not leave you without it. But stay tuned for that. So to stay tuned and to get these notifications, you're going to have to subscribe and hit the bell. You should be doing that. And if you're brand new to the channel, this is pretty much how it goes. Most trading psychology videos just give you these very broad, high theory tips that you can't really use. I like to drill down and give you actionable things you can actually do right now. And I'm going to try to carry that forward through this entire year. But be smart and allow FOMO to become a good thing and use it to your advantage. If you have taken an intelligent approach and you have done proper due diligence and you have a plan of action going forward, then use FOMO to be that one thing that takes you across the starting line so you pull that trigger and go get it.